All right, so this is our third lecture, and um today we'll be talking about what is okay, today we'll be talking about capital asset pricing model. It is one of the basic financial model or asset pricing model you will get in finance. And when we talk of capital asset pricing model, it's talking about relationship between return on an investment and its market risk or its risk, okay, and its risk, okay. So that is a capital asset pricing model. Uh, so basically it's look at the relationship between return on an investment. So whatever you invested in, the return in relation to the risk that that investment is likely to face, or you are likely to face as an investor. Okay. Now the I always say that in finance, in order for us to be able to come out with a formula, we have to be assuming things, which mostly it doesn't happen in the real world, right? That it doesn't happen in the real world. And under capital asset pricing model, it was not an exception. And there's some assumption that come with capital asset pricing model. And the first one is competition and efficient market. You understand competition, right? Now let's talk of efficient market, right? When we talk of efficient market, we are talking of where securities reflect information. And when we talk of security reflecting information, then it means that it will be very difficult for an investor to beat the market, eh, to identify mispricing in the market system, right? And to be able to make profit consistently, meaning that consistently trading in the market. Do you get me? Meaning that if you make returns, then it is solely by luck. It's not because there is mispricing somewhere, right? If a security shares are reflecting information, then it becomes difficult for you to beat the market. Why? For instance, efficient market hypothesis, we have three forms. We have the strong, the semi-strong, and the weak. And when we talk of the weak, where the security reflects only historical data, meaning someone can base on the current information or insider information to what beat the market. Okay, when we have the semi-strong, and semi-strong, it reflects the historical data and information, public information, meaning that the only way you can beat the market is when you have an insider, right? Insider information, then you can beat the market. Then we have strong, efficient market. And when we talk of strong, efficient market, then it means they say that security in that market reflects all the information, and therefore it becomes difficult for you to beat the market, to identify mispricing, to be able to make with a profit or get some returns on it consistently. Okay, so that is the assumption. The next assumption is that it assumes that all investors are rational. It assumes that all investors are rational. And when we talk of rationality, we are not always rational. We are not always rational. Investors are not always rational. Human beings are not always rational. Sometimes we are not rational, but then to be able to come out with a formula, we have to what? Assume that investors are what? Rational. Okay. We believe that money is hard to earn. So if you are investing, at least at that moment, you should be rational, right? In dealing with your money. Okay. The next one is the only prevailing rate is systematic rate, which is measured by what? Beta. The only prevailing rate is systematic rate. And when we talk of systematic rates, we are talking of rates that reflect in the market. In an economy, you can't do anything to reduce it. You can't anything to You can't do anything to diversify. You can't control it. So that's the risk we look at. Then we have all securities in the market is liquid and divisible, right? Anytime you hear of liquidity, we are saying that it is easy to sell, to get your money without losing what significant what value. Okay, so if I invested in shares and at the end of the day, I feel like okay, I want to sell, I can sell and have some capital gain. I can sell my share easily. Then we say it's liquid. However, if it's difficult to sell and by selling it, you would have to lose a significant value of it, then it is not liquid. Okay, all right. Then we have borrow and lend out any amount of money at risk-free rate, right? Risk-free rate. So that is a rate is not realistic. Even in our economy, you can see that the rate that they pay for treasury bill, that's not the same rate that they charge on our what? On our loans when we go for loans. Did they charge the same rate? No, they don't. But they are saying that they are assuming, and so it's just an assumption. Okay. Now we want to understand risks, types of risks. And by types of risk, we have systematic risks, we have unsystematic risks, and we have total risks. Okay, systematic risk, unsystematic risk, and we have total risk. The main classification here is systematic and unsystematic risk. Okay, now systematic risk, we are talking of risk that is you can't control, risk that you can't control. It affects it is a market condition, it affects the market, it affects everything, and you cannot control it by diversifying your investment. No, you can't control it. And a typical example is inflation. When our inflation got to 52 something, we are all suffering. Everything is increasing. Everything is increasing. Now, if you go to the market and you are buying yam, it's expensive. You are buying plantain, it's expensive. You are buying maize. I went to market, I was buying condo, and they were giving me the same quantity. I said, but this is the time that we have harvested. We have like corn, so at least you should add more. You should add more. But this is a systematic risk, so it's affecting everything. Okay, then we have unsystematic risk. Unsystematic risk. When we talk of unsystematic risk, we are talking of risk that you can control. You can control by diversifying. This risk is specific. It's either affecting a specific firm or a specific industry, meaning that if you are diversified, and the other, I told you that one thing you should consider when diversifying your investment is correlation among the investment. Correlation among the investment. If the correlation among the investment is low, if the correlation among the investment is low, then it means that what is affecting this industry? One of if your asset, your one of your investment is in a particular industry, what's affecting the next industry, your other asset that you invested in should be in a different industry, right? Meaning that if this industry is affected, then it will not affect. So this is what unsystematic risk that is affecting specific firm, specific industry. It is not fundamental. It is not affecting everything. It's affecting a particular firm, is affecting a particular industry, is affecting a particular section of the economy. That is what we call what unsystematic risk. That is what you can diversify. Then we have total risk. When you talk of total risk, I would say it's the combination of what systematic risk and unsystematic risk, right? That's why we call it total. Nizini ni when I'm say, nizini ni when I'm say, nizini abade ni when I'm waiting. Or say it's total. It's considered every market volatility, inflation increase, interest rates, volatility, fluctuations in interest rate, everything, both specific to a firm and general, right, in the market. So that is what we term as what? Total risk. Okay.
Doc,
Now,
sorry, the slices were not moving.
I just moved it. Everything I was saying,
okay,
it was all year, or you couldn't say it was all year, right? Just follow me. I'll make it very brief on the
Okay.
slide, so just follow me. Now, under capital assets pricing model, we have two main types. We have capital market line and we have security market line. They are all establishing relationship between return and risk. Okay, they are all establishing relationship between return and risk. And when we talk, it's capital market line, and there's the line, capital market line. And you see this line that is moving from risk-free upward, right? You see this line? It is indicating relationship between what expected return and total risk. Expected return and total risk. Okay, that is capital market line. Is what it's established, or it's a line that shows relationship between expected return and total risk. Okay, right. Okay, so that is capital market line. And now because it is total risk is being measured by what? Standard deviation. Total risk is being measured by what? Standard deviation, right? Standard deviation. In other words, standard deviation consider all forms of risk, not the one that is limited to the market or that affect everything. It considers specific and general risk. So standard deviation, with standard deviation, when we talk of standard deviation, we are looking at how returns disperse around the mean, right? How returns disperse around the mean, or the return mean, or the mean of the returns. Okay, so that is it. Now let's see, how is it different from security market line? How is it different from security market line? Now, security market line establish relationship. There's the line, right? There's the line. It's established is a line that shows relationship between expected return and systematic risk. Expected return and systematic risk. Okay, expected returns and systematic risk. Right. So that's it. That's what is showing the relation. So I've just showed I've just given the graphical representation here, which is showing the line, and I'm explaining for you to see, right? So I said capital line versus security market line. Meaning I'm trying to show you the difference, right? Now, because it's systematic risk is being measured by what? Beta. Systematic risk is being measured by beta. So whenever we talk of beta measuring risk, we are talking of how your investment, right? The risk of your investment relates with the risk in the market. How the risk of your investment relates with the risk in the market. So this is the sign. This sign represents what? Beta. Okay. This beta. This sign is representing beta, and this sign we know from JSS, standard deviation. Okay, that's why we say total rate is being measured by it standard deviation, and systematic rate is being measured with beta. Now, beta, when we say beta is 1, then it means that your investment is as risky as the market risk. Is as risky as the market risk. When it's less than 1, when it's less than 1, then it means that is what is less riskier than the market. And if it's more than 1, we say it's what? Aggressive. And we say it's aggressive, meaning this is not the case. I think when I snap it, then the case came in. So when it's more than 1, we say it's aggressive, meaning it's more riskier than the market. Okay, are we okay? So far, are we okay?
Yes, okay.
All right. So now I will go over. I will talk of the market, a capital market line, explain the graph to you, then I'll come back to security market line. Okay. So now this capital market line, and this how it look like. This is the horizontal axis, this is the vertical axis. Okay. Okay. And on the vertical axis, we have expected return. On the horizontal, we have what is the standard deviation. There's the line moving from what? There is free towards capital market line. And we have this curve that is called efficient frontier. Efficient frontier. When I talk of efficient frontier, we are talking of maximizing your return at a given risk. Maximizing your return at a given risk. Maximizing your return at a given risk. Okay, that is the meaning of efficient frontier. It can also be defined as minimizing your risk at a given return. Minimizing your risk at a given return. Okay, now so this is capital market line, and this is the formula. Okay, in the formula you can see that we have standard deviation, because it's measuring total risk, and standard deviation measures total risk. Okay, so that is it. So capital market line is showing the relationship between expected return and total risk. Okay, now let's have the security market line. You see, security is a security market line moving from risk free, right? And it's showing the relationship between expected return and systematic return, meaning that if you are asked what's the difference between capital market line and security market line, you say capital market line is a line that shows relationship between expected return and total risk, while security market line is a line that shows relationship between expected return and systematic risk. Okay, all right. So they can also ask you for another difference. You can say that the risk of capital market line is being measured with what? Standard deviation. See, there's a sign for it, and then that's the formula. And the one for security market line is being measured with what? Beta, right? Okay, so that is it for a capital market line and security market line. Now,
question.
Yeah.
Please, how then will you deal with an unsystematic risk? Is it going to be the difference between the total risk and systematic risk?
Definitely.
Okay.
I've never really solved a question, but if the combination of systematic and non-systematic risk is going to be equals to total risk, then if you see a question where you are giving information for systematic risk and giving information for total risk, then you definitely, when you subtract the systematic risk from the total risk, you're going to get unsystematic risk. Okay.
Okay.
All right. Are we okay? Can we continue?
Yes.
Yeah.
Yes.
Okay. All right. So there's it. I said beta what? Measure how shares or portfolio risks move in relation to the market as a whole. I don't know. I don't big risk. It measure how shares and portfolio moves. Wow. It should have been market or portfolio risk moves in relation to the market as a whole. Okay. So, and we have standard deviation. It measures how returns of an asset they spread around its mean or its average. Okay. So that is, I said, at this level, I'm not going to solve question with you. Not now that I'm coming to worry you. I don't want to worry you. If I'm giving you a question, I'm giving you intellectual question that you apply reasoning and thinking. I'm not going to solve math or anything with you here. Okay. Now let's go to behavioral finance, right? We are grateful to those who introduced behavioral finance, right? Because some of the assumptions I told you in finance are not rare. In the real world, it doesn't hold, right? And behavioral finance came to address all these things. Behavioral finance recognizes that our behavior, investors, our behavior, or financial analysts, our behavior is being influenced, can be influenced. Let me say, not all, but can be influenced by our psychology. It can be influenced by our emotions, right? It can be influenced, and meaning we will not make rational decision every time. Okay. So I started here by indicating that traditional financial theory believes that market and investors are perfectly rational. That we are what? Perfectly rational. Okay. Then it's also believed that investors are always there to what? Always care about their utilitarian characteristics. And whenever you hear utility in economics, in finance, it's talking about a person maximizing his or her satisfaction. It's talking about a person maximizing his or what, or her satisfaction. Okay. All right. Then he said investors have perfect self-control. Investors have perfect self-control. I don't know the human being we have anything like perfect, right? Perfect self-control. Perfect. Okay. And traditional financial theory believe that they are not confused by cognitive error or information processing errors. Cognitive errors or information processing errors, right? Then behavioral finance theory came in and said investors should be treated as normal and not rational. We are normal. We can make mistake, right? We can what? Make mistakes. So we are what? Normal. We are not, every normal human being can make mistake. We are not perfect. We can what? Make mistake. We just try to minimize our mistake. We can make mistakes, and that should be recognized. So behavioral finance is recognizing that, and that's the truth. Okay. Then they actually have limit to their self-control. It's true. If even God said don't tempt, because don't tempt God. Don't tempt God. So if you tempt me, you think I should be perfect. I can't. There's no way I can be perfect. Do you get me? There's no way I can be perfect. And behavioral finance is saying that we actually have limit to our self-control. Every one of us have limit to our self-control. No matter how good you are, no matter how quiet you are, no matter how silent you are, no matter how educated you are, we have limit to what? Our self-control. Okay? Okay. Then the next one is investors are influenced by their own biases. Investors are influenced by their own biases. So biases, as we go along, we learn some of the biases, and these biases do influence us. Then investors make cognitive error, that can lead to wrong decision or information processing error. Sometimes we have information, sometimes you can do something and later on you ask yourself, why do you even do it? Because you had all the information, but you still ended up making what? In you processing the information to make the decision, you made an error. So you later you sit down when you are rational enough, you sit down and you wonder, so why did I do that? Okay. There are instances I've done things that I would think like, oh, but why did I do this? Okay. Why did I do that? I had all the information, so why? Okay. So we have limit to our, then we can make cognitive and information processing error in relation to our investment or our financial, meaning that financial specialists can make mistakes. With all the financial information, they can make mistakes, right? They can make mistakes. So sometimes you see people, when sometimes people are standing behind the scene and they are talking, unless they get there, that's why you know that you can have the information and still make information processing what? Error. Okay. But when you're saying, so you know all these things and you did that, so you had all this information, they told you all this and you still ended up doing this. Do you get me? So that is it. We are normal human beings. Okay. Decision making errors and biases. One of them is self-deception. Self-deception. When we talk of self-deception, you are talking of you thinking you know more than what you know. And if you think you have understanding of the financial market, you might mislead yourself and not pay attention to expert advice or data. Then you end up making what? bad investment decisions. Okay. Then we have heuristic simplification. That is you having what? Making information processing error. You have all the information, you have the data, you have all the experts, and you still ended up making wrong investment decision because whilst processing the information, you made an error. Okay. Then we have social influence. Social influence. Sometimes we are influenced by others. The way people talk can influence you, right? Sometimes when you when you feel someone is big, has made it, you sometimes fail to really process an information when the person advises you. You think the person knows everything. The person has made it, so if you follow the person advice, you make it. So when we are influenced by what others, that is social influence. Then we have emotion. That is mood string, right? Mood string. If you are in a good mood, if you are in a bad mood, when you are in love, the way you make decisions. So that is example of some biases in 4 main classification. Okay. All right. So we have what? Self-deception, heuristic simplification, social influence, and emotions. Now, let's also look at these common financial biases. We have what? Heuristic. Well, it is a rule of thumb where we make difficult decisions are simplified. Okay. It is where we find a way to simplify complex decisions concerning our investment and financial decisions in general, right? Okay. Now we have examples, we have representatives, right? Now, sometimes to make decision whether to invest in asset A or not, you can simplify it by looking at its past performance. If the past performance or historical performance is good, you can just assume that if it is good, then it will always be good, right? So for you to go through all this, you have simplified it by basing it on what? Historical performance, that it will reflect in its future dealings. Okay. All right. So that is representative right here. Then we have availability biases. This is where you are tempted to assume that the recent behavior of a firm, or the recent activity or recent performance, let me use performance because we look at performance, the recent performance of a firm is likely to what? Happen. It's likely to happen in future, or it's likely to continue in future. And then you base on that to make investment decision. Then we have what? Anchoring. What is anchoring? Anchoring has escaped me. Oh. Anchoring is when you fail to let go of your beliefs. When you believe that when you only enter into investment or make investment decision, when the information you have conforms with what you believe in. So if the information you gather conform with your belief, your beliefs, then you go and invest in that firm. And we are saying that this can hinder you or prevent you from paying attention to other information that could help you to make what good financial decision. Or it also prevent diversification. Because when you talk of belief, normally when you believe, it means everything you are now thinking of investing in are going to be closely correlated, right? They are going to be closely correlated, meaning that you are going to diversification here is going to be what affected, and we know that we are advised to diversify in order to minimize what risk. Okay. And then we have overconfidence. Overconfidence. So this is where you believe that you have, you have more information. You understand the financial market more than the gurus, more than the financial experts. You understand the financial market more than the data available or the information available. Then you are likely to what make a wrong investment decision. Okay. So no matter how good you think you are, still gather information. When it comes to investment, when it comes to financial decisions, right? Still gather information. Still listen to experts. With a neutral mind. Not that you are listening and think, oh man, I know more than you. No, okay. Then we have prospect. Prospect. When I talk of prospect, we are talking of how people relate to losses, gain, and fear in terms of what in investment. Okay, in investment, how these factors, loss, gain, influence their investment decision or their financial decision. So the first one we have a type of prospect is regret aversion. Regret aversion. This is where a person who is making investment decision or financial decision, it just is more concentrated on he or she not losing, because he feels if he lose he regrets, and he regrets. So his mind is, I don't want to regret later on after making this decision. All right. And he's so concentrated there that sometimes the mind is very powerful, and sometimes you'll be seeing other relevant information, but your mind is this one. Well, let's work this one. Well, let's work this one. Let's work for instance. Okay. All right. So that is then loss aversion. This one to this person is concentrating on the loss rather than the gain in whilst making the investment decision or the financial decision, and at the end of the day, it's going to affect his or investment decision. Okay. Then we have mental accounting. Mental accounting. When we talk of mental accounting, we are just saying that people have subjective relevant for the value of money. Okay. The value of money. People have subjective perception. People have subjective uh, value placed on what a particular amount of money. People have subjective that. Okay, so let's say something that, let me use an example that you remember. Okay, so you are dating which should I use? I don't want to use. Okay, let's say you are dating a student. Let me use student is a perfect example. I'm not going to mention anyone's profession. So you are dating a student and you are dating a worker, right? Now, when a student buy food, all other things being held constant, because some students are from very rich homes, so they don't feel it. When they buy food 50 cedis for you, the way they feel it, they place value on that 50 cedis that they used to buy food for you. Then you are dating a worker, all other things being held constant, the person is earning average amount. 50 cedis is nothing for the person to buy food for you. Okay. All right. So the same way in investment or in financial decision, you are going to invest. Sometimes the returns on the investment is not much. Some people will feel that return to be really insignificant. based on the value they place on their money. Others too will see the same return and think it's huge, right? So, for instance, I was told someone's capital is 50 cities, and I was, wow, 50 cities capital. Eh? And so to me, it's not money, right? But to the person, it's money, and the person was able to work with this 50 city feed on it with one child, or with one child was able to work 50 city feed on it for say 2 months or so. No, say the person is saying that uh the money, like the money has like he has lost the money, or I would like say lost. um I think the money is no more enough. Not that that the money has reduced, and somehow it's expenses that exceeded the capital. So that was like, wow, 50 cedis. Get me? So that is subjective value we place on what the an amount. Okay. Then we have heading. Heading is where your investment decision is being influenced by others, the action of others, the views of others, the activities of others. That is heading. And then we have conformity bias. Conformity bias, meaning that when people are making investment or financial decisions, they want it to be conform with their belief they already have. So if it conforms with it, they go for it. If not, they don't. Then we have cognitive bias. Cognitive bias is when the cognitive, you are talking of the process of processing the information, right? So this is the error, investment error, or the error the person makes as a result of the information either conforming or not conforming with his or her belief. Okay. Then we have home bias. Home bias. Sometimes we feel we understand our home market better. That, like for instance, there's a lot of corruption in Ghana, but if you feel you understand it, if you think that corruption, you understand it better than to go to a foreign country and what and go and invest. And because of that, it hinders what international diversification. And know that when we talk of international diversification, we believe that the correlation is very what low. The correlation is very low, meaning that what is happening here is not is there's less likely that's helping a different country. So meaning that type of diversification is encouraged, right? So that's another thing. We have gossip. People are gossiping about something, you listen to it, and they influence you. Okay. I believe you, me DKM, when it came, many people knew it was a Ponzi firm, but you hear gossip. Charlie, this person went and the person has made this amount. So this person went and the person has made that amount. And human being, as greedy as we are, we just go and invest. Okay. And this can affect your what investment decision. Okay. So that is it. All right. So that is the ending of the first part of our lecture for today. Any question? Any question?
Madam, there's no question, please. I don't
Okay,
have any
meaning
question.
okay. So can I ask questions?
That's right.
Okay, so I don't know that how many lecture is left for us finish. So let me do this.
We have more time.
How many weeks left?
Oh, come on. Next week we'll meet face to face I don't like about 6 or so.
Hey.
6 or 5.
Oh, okay. But when you sent that, it was only 5. Oh. That's why even that day I made that to find a time to replace it. Okay. No worry. At least we use it to be
It will be
presenting
more than 4.
the papers we are going to publish. We will just
But
keep
next week,
it. Representatives, all of us will be making comment on it. Okay, so we are moving to asset valuation. Asset valuation. I think that in finance, when we use value, they want to know the value of something, the price of something, then we want to know the present value of the thing, right? We are interested we are interested in the value now. We are interested in the value now. I've told you this thing. The finance, we are interested now value, now value. Okay, so we are interested in the value now. So it is the present value of expected cash flow from assets invested in, and asset in this case, right? Because we have different definitions. If you go to accounting, they will define asset for you. Me under this lecture, asset is conceptualized as what? Investment vehicles that we invest in. Investment vehicles that we invest in. And we have two main classifications of this assets that we invest in. We have the rare asset and we have the financial asset. And when we talk of rare asset, we are looking at in things that we invest in that contribute directly to the development of the economy, right? That contribute directly to the development of the economy. We have land, we have burden, we have knowledge, right? So right now, the knowledge I have is contributing directly to the development of the economy, because you are going to perform better in your field, you are going to perform better in financial activity. So I am contributing to the economy directly, okay? Then the next one is what? Financial assets. Financial assets. When they talk of financial assets, we are talking of securities. Securities that are traded in the financial market, right? And I brought two examples. These are the traditional securities we have. We have bond and shares. We have derivatives, also the futures, forward options. They are also there, but I just brought this example. Bond and shares are the traditional examples we have, okay? So that's it. Now, let's talk about share valuation. Share valuation. Share valuation. Okay. Now, before we understand share valuation, let's understand shares. Shares. So this is the meaning I gave you based on my understanding, that it is one of the means a firm raises funds, and it gives the buyer ownership right. Okay. That is shares. Okay. Then we have two types of shares. We have ordinary shares and preference shares. Okay. Ordinary shares, we term them as true owners, because whether they are paid or not, they are owner, whether your firm perform well or not, you are with them. Whether they give you returns or not, you are there. They don't have a fixed rate that they have to be paying them returns, right? Then we have preference shares. Preference shares also give you ownership rights. However, they are considered more, or they are considered first to ordinary shareholders when profits are made. Okay, and they have fixed rate that they are paid. Okay, so these are preference shares. Okay, now shares are traded. I want to know the where and how they are traded. Now we have over the counter versus physical location exchange. Okay, so over the counter normally involve small firms. They trade or they sell their securities mostly by contacting themselves directly, either through phone, through an email, but they contact themselves directly. However, physical location exchange, like Ghana Stock Exchange, it's an example. It is, we normally deal with big firms that have gone public, they are listed. All right, these people, they trade there. It is more organized, right? Then that is a physical location. Then we can also look at initial public offering, IPO versus primary market versus secondary market, right? Look at the name, initial public offering, initial. That is when a firm wants to raise new funds. The first first shares they issue. That is the new shares, the first shares they issue. Okay. Then we have primary market, also for trading new shares. It is very difficult to break the difference between this, but it's very new. Like when they want to raise new amount, then this is also for trading new shares. Then we have secondary market for trading existing shares, meaning that if I go and buy the shares, then I want to sell to another person, I go to secondary market, okay, to trade. Then we have money and capital. Money market for trading short-term what security, like treasury bill, right? Treasury bill is an example, of, okay, let me say treasury bond. It's an example of what? Bond, okay? It's an example of bond. And treasury bill, let me say treasury bill, yeah. Then we have capital market for trading what? Long-term securities, okay? For trading long-term securities. So bond in general, mostly is long-term. Corporate bond mostly is long term, mostly, okay, mostly. That doesn't mean they cannot have short term. As if they are able to trade less than 1 year, then it becomes what? Short term, okay. Now, who is a shareholder? When you are cash shares, you become a shareholder. You have ownership interest in the firm, and when you become a shareholder, you have certain rights and privileges you enjoy. Right to vote, right to vote. Then preempt right. I don't know why they term this one as, I don't know. So, but preempt right means that you are considered first when they want to what? Sell shares, right? So if you want to buy, they will sell it to you first before they consider an outsider. The purpose here is to maintain control, right? To maintain control. Okay, so if you want to maintain control, when they want to raise new funds through shares, you buy. Because if you don't buy yourself and external person, new people buy it, your control in the firm is likely to what? Reduce. Okay, all right. So that's it. Expectations of shareholders. Expectations of shareholders. Shareholders expect dividend. Dividend. That when the firm make profit, they should give them dividend. Okay. They also expect capital gain. And I don't know why I brought loss here, but it's gain we expect. Loss is the rate associated with it, right? So they believe that, hey, if I buy shares today and I sell tomorrow, the value of the share. That's why normally you start. They said firm should maximize shareholders' worth. And that's what boosts the interest of people to acquire what shares. All right. So if the main purpose is to boost shareholders' worth, if you're able to boost the worth of a firm, the shares price will increase. And that meaning that if I am an existing shareholder and I want to sell, I'm going to be better off because I'm going to have what? Capital gain. Okay. So that's it. Now, what is share evaluation? All those that this can be talking about is just for you to understand shares. Okay. Now, share valuation is the what? The present value of expected cash flow from investment in shares. So the dividends and even the capital gain, right? But mostly, I've never taught corporate value model before. I always do the dividend growth model, and very soon I have to go and read on this and teach. I don't know whether that one take capital gain into consideration, but so far, dividend growth model, we concentrate on ways of determining the value of shares. We concentrate on dividend, right? We concentrate on dividend. Okay, so that is it. I'm here to read on corporate value model and to prepare lecture notes on it. I think that's the only thing I don't have in my corporate finance lecture notes. So if they stop giving me new courses, it's like I'm always taking new courses that I have to prepare. So if they stop and I'm less busy, I'll do a lecture note on that one too. Then we have ordinary shares. How to determine the value of ordinary shares. You can see discounting factor. Discounting the dividend, that will be what? The future cash flow, that is the dividend. We are discounting it to the what? The present value. So that's how we determine the present value of what? Shares, ordinary shares. Okay. Then when we assume perpetuity, you understand perpetuity? Where we believe that the same amount will be paid over unforeseeable future. So there are instances businesses have been paying the dividend consistently, the same rate, right, or the same amount. Then we say then we can assume perpetuity for that firm. And whenever we assume perpetuity, we divide the dividend by the rate. Okay. Now, there are instances that we have non-constant dividend growth, right? Where today we pay once, in the next day you are paying 50%, another time we pay once 50%, the next time is 70%. Okay, then it means it's not constant. Okay, it's not constant. So with that, we have a way of calculating it. First, we calculate expected dividend for the period, which involves supernormal growth. So we calculate them. Then normally the questions somehow, I don't know whether it is Ghana that maybe I don't think there should be one-way question, but normally since I was a student, it has been non-constant growth, then it become perpetual, then become perpetual. So we calculate the non-constant one, then we come and we find the price for the last non-constant one, and that means discounting the previous year, which is constant, to get the price for the current one. Whenever you hear price, present value, we are discounting the previous. Is it previous? We are discounting the next year, not previous, the next year to the current year. Previous is, but no, the next year, and the preceding year, right? To the current one, okay? So that is it. Then let's talk of preference shares. Preference shares. Although the preference shares are also shareholders, but they have fixed rate, right? Now, normally, we see preference shares to be hybrid. And why are they hybrid? We say they are hybrid because they have certain features of ordinary shares and certain features of bond. Now, let's look at the features of bond. Yeah. They have fixed rate, just like bond have fixed rate, right, that they pay to them. All right. 2, they are considered first before ordinary shareholders, just like bond are considered first before shareholders in general. Okay, so that made them resemble bonds. Okay, then we have why do they resemble shares? Now we say in the effect of we not being able to, a firm not being able to pay preference shareholders, they will not be declared bankrupt. So even though they are considered before ordinary shareholders, if they don't make enough, they can decide not to pay them. Okay, so that is what is making it hybrid. Okay, so we have moved from what? From shares, let's talk about bond. So we just talk about the two financial assets I gave in the above slide. What is bond? Bond is a long-term debt where interest or coupon rate is paid over the period of the bond, the specified or agreed period of the bond. And on maturity, the principal amount is paid. Okay. All right. So that is bond. Then we have some classifications of bond. We have treasury bond, we have corporate bond, we have municipal bond, and we have foreign bond. So what is treasury bond? Treasury bond is government bond, where we believe that the risk associated with it is what? Low, right? Risk-free, okay? Risk-free bond, okay? Then we have corporate bond that are issued by companies, by firms, by businesses. These are called what? Corporate bond. Now it's subject to risk, default risk is subject to default risk. Either they will not pay your principal, they will not pay your interest, or you not even get any of them, right? That is corporate bond. Then we have municipal bond. Municipal bond. Municipal bond is normally given by the local government, and mostly you don't pay tax on it. I don't know whether it happens in Ghana here. Then we have foreign bond, meaning that when you buy bond from outside, so we have this euro bond and stuff. So that's foreign bond. And foreign bond is subject to two types of risks: exchange rate risk and default risk. Okay, so that is it. That is the classifications of bond we have. Then we have characteristics of bond. And when you say bond, it has a par value. Par value is the amount that is given as a debt to the firm, and this same amount would have to be paid when it matures or when the deal expires. And so that's the face value of what? Of the bond. Okay. Sorry. We have coupon interest rate. This is the interest that is paid over the period of the bond life. So that's what the bondholders receive as what their returns. Okay. Then maturity. Every bond has maturity date. Every bond, or other thing, every bond has maturity date. Then we have some have provision to call or redeemable bond. When I talk of redeemable bond, there are some bond, there's an agreement that the firm can call back its bond any moment in time, like, okay. So when they can call the bond back and give you back your money plus whatever they agreed with you, if there was any agreement like that. Okay. All right. So to invest in bond, what are some of the risks you are likely to face? Number one, interest rate risk. Interest rate risk. When we talk of interest rate risk, we are talking of, when interest rate increases, the value of the bond decreases. Okay, so it's the risk of you losing the value of your bond, or the rate that affect the value of the bond in case there was fluctuation in the interest. Okay, so that is it. And I told you that whenever we talk of risk, we don't look at the positive aspect that, oh, interest rates, when it go down, a bond to value grab. No, for us, we are only concerned about the negative aspect, what might harm us, what might hinder us from receiving our expectation. But if it is going to cause us to earn more, we don't, fine, we'll be happy, but we don't look at that, right? Okay. Now, reinvestment rate risk. Reinvestment rate risk. Now, we are saying that if you have invested and they are paying you 10% on your returns as a bond, invested in bond, they are paying 10%, and your bond mature, or even if it's called, and they give you your money, if you are going to reinvest, what the 10 days they are going to earn the same 10%, you might earn what? Less. So that is what? Reinvestment risk. Then we have default risk. And if the firm go bankrupt, they will not pay your money at all. They will not pay your money. They will not pay your principal. They might not pay your part of your interest. They might delay in paying. All these things are default risk. Okay. So that is. So now we come to what is bond valuation. And bond valuation is the present value of all the interest paid plus the principal amount paid on maturity. So we discount all of them to the present value. Then we say we know the value of the bond. So you are going to invest today. You want to know the value of your bond. They've told you the interest you are going to, you're giving the rate, and then you can discount all of them down. And you know when your this will mature, you discount it down to, then you have the value of your bond. Other terms that we can understand under bond, right? We have zero coupon bond. Zero coupon bond. Coupon is the interest paid on it, meaning you're not going to earn any interest on it. This particular bond is normally offered at a discount, right? At a discount, then when it matures, they give you the full amount. So if it is 1,000, maybe they give it to you at 900. Then when it's mature, they give you 1,000, right? They don't pay any coupon rate every month. So that's it. Then we have floating rate debt or bond. Floating rate bond. We are talking of where the interest rate fluctuates. The movement in it. Okay, so that's it. Then we have junk bond. Junk bond. So when you have when this particular bond you invested in, or you want to invest in, it has very high risk, and the returns is not compensatory enough. That is what junk bond. Then we talk of current yield. When we talk of yield, it's just the same as the returns you are getting. Okay, so the present return you are earning on your bond. So these are some of the terms that you should know under what? Bond. Okay, so that is it, and that will be the end for today. Any question?
Hello, Doc.
Yeah.
Regarding the treasury bill, now the theory behind it is that it's a risk-free sort of investment to investors. But using the case of Ghana, our domestic debt exchange program as the typical example, what can experts say regarding this particular theory that have been there for years?
So, in economics, and finance came out from economics. The other I told you, finance came out from economics. We say all other things being held constant. The thing is, government normally does not default, because we believe that if government is not doing anything, it's been a government business is not doing well, at least they can use taxpayers' money to pay the returns. Okay, that has always been the idea here. So, but that does not rule out the fact that if you mismanage your income, I saw that say that when I was introducing finance and financial theory, when I was introducing it, there is something I said. I said that if you fail to manage your money will not survive, right? So even though every month they get tax from me, when I go and buy something, in fact, when I buy food, I can just look at on the sheet and see the number of tax on it. And I'll just be wondering, we have our natural resources bringing in more, but structurally, this country is not doing well. We are not managing our monies well. We are not monitoring. We don't have any monitoring mechanism. But those who are monitoring are the same people appointing people. And I even believe when they are appointing people, they give them conditions before they are. But then when you go there, every contract passed to me, every contract 10%. I believe they do that, right? Because in as much as we've talked of behavioral finance here, we are talking people who have limits to their self-control. People are not always rational. If you keep on making irrational decisions, irrational decisions, in the case of behavioral finance, at the end of the day, we grow tired of you. Okay. So it is this thing hold when the economy is being managed well. And we are not the first. When it came, I think I've forgotten the countries, but it has happened before. So we are there. And so everything we say here is all other things being held constant. Okay. We hold, but we cannot, we wouldn't have been able to explain certain things if we're not holding factors constant. Okay. So they can default, but it's very slim. As they stand now, even to buy treasury bills, sometimes you'll be thinking, when will these people just get up one day? You know, doing something for the first time is difficult. But the moment you do it, let me stop recording.